Let's look into STAG Industrial, and this is a REIT, and we need the market cap 4.2 billion. Pretty small company, and the stock price is 28.26. Now we know the shares outstanding. It's a market cap divided by stock price, 149 million shares. And the way you calculate the intrinsic value of a stock is you estimate the future free cash flows of the company, then you discount that number back to today's value. That gives you the value of the entire company. Then you divide that number by 149 million shares to get the intrinsic stock price. And we compare it to the actual stock price, and we see if the stock is a buy or a sell. So let's get started. We need the actual free cash flows, and let's go back to Yahoo and go to the cash flow section, and we can pull 4 years of cash flows. It's all positive, so that's a good sign. Now the net income, that's on the income statement, and that's a profit and loss for a given time period. Also positive, good sign. When there's negative numbers, it makes it hard to run it through a discounted cash flow model. And also, REITs are especially challenging to forecast because there's a lot of differences between the way a REIT's set up and the way a regular company's set up. And I actually, inside this model, even though you don't see it, there are 4 separate models depending on the type of company, and there's also a REIT model also built in. So there's just like a switch I check off that, and it seems to be working so far. The REITs I've done, I'm able to get an accurate value. So now let's figure out the capital structure of this company so we know what to discount the future cash flows by. 54,647. 54,647. So $54 million of interest is what they pay on their debt. Let's see how much debt they have. So the current debt, no current debt, long-term debt of 1.6 billion. So they pay 3.3% interest on their debt. Now, interest is tax deductible, so let's get their effective tax rate. We'll go back to the income statement. And, well, I forgot, REITs don't pay taxes. That's one of the benefits of being a REIT. So we can forget about that part. So the cost of their debt is 3.32%. And they have 28% of debt in a capital structure, which isn't too bad. That's a manageable number. Now let's find out the cost of equity. The beta is 0.98. That's a volatility of a stock. And to calculate the cost of equity, there's a capital asset pricing model, and that comes out to 9.85%. And to get the WACC, the weighted average cost of capital, that's a blend of the cost of debt and the cost of equity, and that comes out to 8%. And that's what we're going to discount the future cash flows by. And that's probably what this company discounts its investments by as well. Now, the estimated future free cash flow, we did it for 4 years. Then we did a terminal value, which is all years past year 4. And now we're going to discount those numbers back to today's dollars, and we get a value of the company of $3 billion. And when you divide that by 149 million shares, you get a stock price of $20. Even though it's trading at $28, so we consider this a sell. It's trading at a 39% premium. So $20, let's just look historically. It was trading around 20 in March, and maybe, yeah, it's always been trading in the low 20s and up to low 30s. So it's a pretty tight range. But the reason a lot of people invest in REITs is for the dividends. They tend to pay a high dividend, and actually they're required to distribute 90% of their profits in the form of dividends. That's why they get a tax break, and they don't pay taxes, because the investors pay the taxes on the dividends they receive. So let's dig a little deeper into this. Let's look at the ratios of STAG and see if we can get a little more color on the company, because although discounted cash flow models are really nice, sometimes looking at the ratios can give you a nicer indicator of how things are going on in the company. And when you model deals, I've done this for a long time. It's just there's a lot of assumptions involved, and it's just hard to get an accurate prediction of the future. Not many people can just predict the future. I'd be rich if I can, but we try to get as close as we can with the information we have. So I'm pulling the current debt, the current assets and current liabilities from the balance sheet to populate all my ratios. So the PE is the price over earnings, and I'll show you the notes. So if you want to pause the video. In my phone I have a ton of notes and everything, and I always keep adding to it. So I just kind of pulled my notes and put it into my spreadsheet, so it's easier for me to convey the info. But generally, a PE, I want to see 15 or less. That's considered a strong PE. Of course, you can't just look at one number. If somebody has a high PE but they have really good other numbers, you have to kind of put it all together. But the PE is just the stock price over the earnings per share. And earnings per share is the net income over shares outstanding. And 85 is a really high PE. So that means people are willing to pay $85 for $1 of profit. So it doesn't sound so great. But it is a REIT, so you can't just say, oh, it's high, therefore it's bad. You need to compare it to other REITs. That's what you do with any ratio, is that you compare it to similar companies. You don't want to compare it to Apple, but compare it to other REITs to see how it performs. And if all the REITs are around this range, then it's okay. And companies can lower or increase their PE based on how they report their financials. So you have to look into that as well. Now the PS, the price over sales, is the price of the stock over the sales per share. And the sales per share is just your sales over shares outstanding. Sales is the same as revenue. I like to see under 2.2. But like I said, it is a REIT, so you're investing for the dividend. So maybe some of these ratios aren't as important. But there's a lot of like positives and negatives with all the ratios. So you have to kind of understand the nuances. And the next one is the PB, price over book. So it's a stock price over the book value. And it's good to understand what book value is. It's just the equity. It's just the assets, total assets minus total liabilities. So it's just a value of your company according to the balance sheet. Now that doesn't mean if it's a really valuable company, you should take it the number how it is. You should kind of look at the numbers, because there are things in your assets that could really inflate your equity number. Like there's a lot of intangible assets like goodwill or patents or trademarks that are assets, but they don't really have value. To the firm they do, but you can't just go sell them like you can with like your inventory or your investments. But generally, I like to see under 3.3, and this company has under 2, so I consider that a good sign, at least for their balance sheet. Current ratio is another important statistic to look at, because it's how you're able to pay your current liabilities. It's current assets over current liabilities. And I like to see between 1.2 and 2. If it's under 1, that just means they don't have enough money to pay their short-term liabilities, and they could go bankrupt if they can't borrow more. So 2.12 is great. I wouldn't want to see like a 3, 4, 5. That just means they're holding on to way too much cash. ROE is is your income over your equity, and it's how well you invest the equity you received. So I like to see 20% or higher, but since this company gives most of the money back in dividends, it's probably less likely to have a strong ROE. And just for informational purposes, the average ROE in 2019 across all stocks was 13%. So generally you want to see a higher ROE when looking. But when looking at ratios, the great thing about ratios is it puts all the companies at an even level. Because just because a company is $1 billion company compared to $1 million company, that doesn't mean $1 billion company is better. It might be a better investment, it might be a worse investment, but the ratios kind of equalize things. So compare ratios to similar companies in your sector. And also you want to compare ratios over several quarters, because there could be some quarters that you have a lot of expenses, but you're going to be getting paid the following quarter from all your customers. So it may look, one quarter looks terrible, but then it gets cleaned up the following quarter. And that could happen with certain types of businesses, especially like home builders who have to shell out a lot of money up front until they can finally sell the house. And thanks for watching. Yeah, let me know in the comments if there's other ratios you look at, and I can add it to the spreadsheet. I mean, all the numbers in my spreadsheet are almost all set. I just have to just put the number in and just put the calculation. So it's pretty easy. So thanks for watching, and enjoy your weekend.